Please, stop it. You don't need those 100 chart patterns, 100 shapes and colors that the market is actually making to predict the next movement of the market. Trust me, you are just wasting your time. I mean, there's hundreds of those weird shapes and patterns, and trust me, no one is really making profitable trades using all those price action patterns. It's just a waste of time. I mean, all you need is a couple of them, good knowledge on price action, you need to master support and resistance levels, and be familiar with the trending market. Listen, here I'm talking with experience. I made thousands of profitable trades, and trust me, I never used more than 3 chart patterns to understand the movement of the market, because all these chart patterns will only help you understand when the market is making a breakout and making a reversal. So please remember, you need a good strategy. In this video, I will give you the most important ones that you will ever need to make profitable trades with the help of your own strategy. Me personally, I use my own strategy that I'm teaching in my course. The course is in the description below. In this course, I will teach you everything I learned over the years from trading cryptocurrencies, binary options, forex, and many other price actions. The course is more than 5 hours long and contain around 60 episodes where I will go in deep details about cryptocurrency trading. So let's get right into it. Starting with the first, which is the double top and double bottom pattern. Here's where we will be showing the anatomy of each pattern. So first, you have your moving uptrend. Price then makes 2 same highs. The tops essentially makes a resistance level. The swing low here is what is called the neckline. Now, what does the double top tell you from a price action standpoint? Price failed to make a higher high, but instead made the same high, which shows a loss of momentum from the uptrend, meaning a loss of momentum from buyers in the market. Now, going the other way. You first have your moving downtrend, price then makes 2 same lows. The bottoms essentially make a support level. This swing high here forms the neckline. Now, what does the double bottom tell you in terms of price action? Price failed to make a lower low, but instead made the same low, which shows a loss of momentum from the downtrend, meaning a loss of momentum from the sellers in the market. So this then brings us to our next question, which is how do you use the double top and double bottom pattern as part of your overall strategy? Now, these are the 4 core variations to using the double top, double bottom patterns. Let's start with the first, which is the neckline break entry. So you first have your double top pattern that forms. Neckline here, because as you can see is created by the swing low. Here, once price breaks the neckline and it makes a lower low, you will open a breakout entry short because the reversal and the trend change are now confirmed. Going the other way. You first have your double bottom pattern that forms. Neckline here, because of the recent swing high. Now, once price breaks the neckline and makes a higher high, you will take a breakout entry long as the reversal and trend change are now confirmed. So, moving on to the second variation. A double top or a double bottom pattern forming at a key level. Now, this is an entry that occurred on Ethereum and one that many of my students took. So you first need to identify a key level, which you have through these 3 reversal points. As price comes back down, it creates a double bottom pattern at the support level. So, again, to confirm the reversal, neckline placed at the recent swing high, and once price breaks through the neckline, it makes a higher high, the trend changing from a downtrend to an uptrend is confirmed, and you would then open a long position through the lower intraday time frame. Now, to point something out, there was another trend change confirmation you could have used, which was placing a trend line like this, connecting the swing highs, and again, waiting for the breakthrough before looking for trade entries long. Now, going the other way. Again, you first need to identify a key level, which you have through these reversal points here, giving you your resistance level. As price comes back up, it creates a double top pattern right at the resistance level. So again, to confirm the double top reversal, neckline placed at the recent swing low here, And once price breaks through the neckline and makes a lower low and trend change from an uptrend to a downtrend is now confirmed, you would then take trade entry short through a lower intraday time frame. This is also a very good example of the many different opportunities there are to open trades. Some would open the short position right at this point. Others would have entered short right at this point here, where the pattern traders wouldn't enter until the double top pattern formed and then the market break the neckline here. But all are correct. There are multiple different ways to enter trades based on your style. So what does a double top or double bottom pattern at a key level tells you in terms of price action? This kind of entry is of a high quality because you are not trading a pattern at its own, but a pattern that is also at a key level, which means that you also have support and resistance traders looking to enter along with pattern traders, which help create momentum for the trade and increases trade quality. So moving on to the third variation, a double top or a double bottom pattern, but instead of taking a breakout entry, waiting for the pullback entry. So back to the Ethereum example we just covered. You had your double bottom pattern, neckline break, but instead of taking the breakout entry, there was a second long entry on the pullback to the new support level. This is actually a very good level because it was formed way back here. Now, there is a very specific way you must place your stop loss when taking breakout entries, but then a very different way you must place your stop loss when you're taking a pullback entries. So moving on to the fourth variation. Candlestick patterns forming at a key level and then a double top or a double bottom pattern inside of those candlesticks. So you first identify a key level, which you have through this reversal point here, and which gives you a level of resistance. As price comes back up to this level, you are waiting to see if you will get candles forming at the key level and to show a reaction to the level of resistance, which you got through this long wick candle. But a reaction doesn't equal an instant trade, as price can stall at the key level and still break right through. And don't forget that this is a very strong uptrend. So what you need to do is, after you have this long wick candle react to the level of resistance, you need to look inside of this area on a lower time frame to see if you can get any form of price action that signals a trend reversal and a change from an uptrend to a downtrend. Now, this is a very key point. Before you look inside of this area, you have no idea what you will find or if you will find anything at all. So let's pull up a lower time frame, specifically the 1 hour time frame, and put it right beside this one. So on the left, the daily time frame we just looked at. On the right here is the 1 hour time frame from the same asset at the same time. This resistance level here is the same resistance level here. This area here, where the candlesticks formed, is the same area here on the 1 hour time frame. Now, the reason we are using a lower time frame is because on the main time frame, where we find the initial setup, price movement is too tight. Meaning, we don't have good swings that give us good price action that signals a trend change after we had the long wick candle. Whereas here on the lower time frame on the right, we can see so much more data and see the actual swings of price. So what you had on this lower time frame is a perfect double top pattern that formed right at the key level of resistance and inside of the long wick candle from the higher time frame. So again, to confirm the reversal and the trend change, neckline placed here at the swing low. Once price breaks the neckline and makes a lower low, your trend change is confirmed from an uptrend to a downtrend. The breakout here is then when you would go to a lower intraday time frame to take trade entries short. Now going in the opposite direction in a downtrend, this will work the same. So moving on the next pattern. The triple top and triple bottom pattern. So price is in an uptrend before it makes 3 same highs in a row, forming the triple top pattern. The swing lows here create the neckline and the support level. And when it breaks, you would take trade entry short, as the reversal is now confirmed. Now, going the other way. Price is in a downtrend before it makes 3 same lows, forming the triple bottom pattern. The swing highs here create the neckline and the resistance level. And when it breaks, you would take trade entries long, as the reversal now is confirmed. So, using the triple top and triple bottom pattern is the same as the 4 variations we showed you for the double top and double bottom patterns. So, we will not go through it again. Moving to the next pattern, the trend continuation pattern. A bullish trend continuation pattern has the runs and the pullbacks. The swing highs are higher than the previous swing highs. Also, the swing lows are higher than the previous swing lows. This means a bullish trend continuation pattern makes higher highs and higher lows. From a price action standpoint, it shows a continuation of a bullish momentum from the buyers through making new higher highs and new higher lows and not a sideways market. Now, going the other way. A bearish trend continuation pattern had the runs and pullbacks. The swing highs are lower than the previous swing highs. The swing lows are lower than the previous swing lows. This means a bearish trend continuation pattern makes lower highs and lower lows. So, from a price action standpoint, it shows a continuation of a bearish momentum from the sellers through making new lower highs and new lower lows and not a sideways market. Now, moving to the next pattern. The trend change pattern. In a bullish market, there are 2 ways the trend change pattern can form. Variation 1. You have the moving uptrend through the higher highs and higher lows before price makes a lower low, giving you the trend change pattern in a bullish market. Now, variation 2. Again, you have your moving uptrend, higher highs and higher lows, before price makes both a lower high and a lower low, and giving you the trend change pattern in a bullish market. So, from a price action standpoint, it shows a loss of momentum from the buyers as price failed to make a higher high and instead created a reversal pattern showing a trend change from an uptrend to a downtrend. In a bearish market, there are 2 ways the trend change pattern can form. Variation 1. You have your moving downtrend through lower highs and lower lows before price makes a higher high, giving you your trend change pattern in a bearish market. Now, variation 2. So, you have your moving downtrend again through lower highs and lower lows before price makes both a higher low and a higher high, giving you your trend change pattern in a bearish market. So, from a price action standpoint, it shows a loss of momentum from the sellers as price failed to make a lower low and instead created a reversal pattern showing a trend change from a downtrend to an uptrend. So, moving on. The head and shoulders and inverse head and shoulders pattern. So before we continue, and if you are enjoying this video, remember I'm investing a lot of my own time to make you these educational videos, so please subscribe and hit the like button. So the head and shoulders pattern start with the market moving uptrend, left shoulder, the head at the swing high, and then the right shoulder at the lower high. The swing lows here make a neckline or a support level. From a price action standpoint, it shows a loss of momentum from the buyers and the start of a trend change as a lower high has already formed. Now, there is a higher quality of the head and shoulders pattern, which is the head and shoulders pattern with a slanted neckline. It's the same as the normal head and shoulders pattern, except you already have a lower low that formed, creating the slanted neckline. From a price action standpoint, this is a high quality reversal pattern because price already made both a lower low and a lower high, which shows a fully formed trend change and not just the start of a trend change. Now, going in the opposite direction. The inverse head and shoulders pattern starts with a downtrend. After that, the left shoulder, the head at the swing low, and then the right shoulder at the higher low. The swing highs make a neckline or a resistance level. So, from a price action standpoint, it shows a loss of momentum from the sellers and the start of a trend change as a higher low has already formed. Now again, there is a higher quality inverse head and shoulders pattern, which is an inverse head and shoulders pattern but with a slanted neckline. Again, it is the same as a head and shoulders pattern, except you already have a higher high that formed, creating a slanted neckline. So from a price action standpoint, this is a higher quality reversal pattern because price already made both higher high and the higher low, which shows a fully formed trend change and not just the start of a trend change. So this time brings us to our next question, which is how do we use the head and shoulders pattern as part of our trading strategy? Again, right now, go to the comments below and let us know exactly what questions you have and topics you want us to cover next. Also, if you are enjoying this video, don't forget to hit the like button to show your support. Now, these are the three core variations to use in the head and shoulders pattern. Let's start with the first, which is the neckline break entry. You first have your head and shoulders pattern that forms. Neckline here because of these 2 points, and once price breaks the neckline and makes a low low, you would take a breakout entry short as the reversal and trend change are now confirmed. Going the other way. You first have your inverse head and shoulders pattern that forms. Neckline here because of these 2 points, and once price breaks the neckline and makes a high high, you will take a breakout entry long as the reversal and the trend change are now confirmed. So moving to the second variation, a head and shoulders or inverse head and shoulders followed by a neckline break, but instead of taking a breakout entry, you will be waiting for a pullback entry. So you first have your inverse head and shoulders pattern, neckline here and then neckline break. But instead of taking the breakout entry, there was a second long entry on the pullback to the new support level. Now, going in the opposite direction, this would work the same. So, moving on to the third variation, which is an aggressive early entry at the right shoulder of the pattern. So your regular entry would be identifying the head and shoulders pattern and taking a break entry short at the break of the neckline here. But now, there was a more advanced way to trade the head and shoulders pattern, which is what we call an early aggressive entry right at the right shoulder of the pattern here. So let's break it down. You first identify the left shoulder and then the head. Now, here's the key. The left shoulder here already makes a resistance level, so you would have drawn in and extended out. As price comes back up to this resistance level, you would wait to see if you would get candlesticks forming at this level created by the left shoulder, which you got through the multiple long wick candlesticks forming at this level. Then, at this point, you would look inside of this area to look and see if you got any form of price action that signals a trend change to confirm that this right shoulder has completed. So, let's pull up a lower time frame, specifically the 4 hours time frame. On the left is the daily time frame we just looked at, and on the right is the 4-hour time frame of the same asset. This resistance level here is the same resistance level here. This area here where this candlesticks formed is the same area here on the 4-hour time frame. Now, on the 4-hour time frame, you had the perfect descending triangle that formed right at the right shoulder and the resistance level from the higher time frame. When the pattern breaks below, this reversal from an uptrend to a downtrend now is confirmed, and also confirms the completion of the right shoulder from the higher time frame. Now, after you had the break, you would go to the lower intraday time frame to take trade entry short using our entry strategy and tools. Now, before we continue, I just want to remind you that in the description below I have a course where I discuss in details more than 30 candlestick chart patterns, and I'm also sharing with you my secret strategy that I use to make hundreds of profitable trades. And again, if you are enjoying this video, please don't forget to hit the like button and subscribe to the channel. Moving on to the next section. Triangles, channels, and wedges. These patterns work as a set because of how we use them as part of our strategy, and you will see why. So let's first go to the 3 core patterns, starting with the triangle patterns. Now, the triangle pattern has its 3 variations as well. We will start with the ascending triangle. So, the top side of the ascending triangle makes same highs and create a horizontal resistance level. The bottom side of the level creates higher lows and allows for an ascending trend line to be placed. This pattern can be formed in both bullish and bearish markets. The bullish ascending triangle starts with an uptrend, followed by the pattern formation. The bearish ascending triangle starts with a downtrend followed by the pattern formation. So, next, the descending triangle. The bottom side of the descending triangle make same lows and create a horizontal support level. The top side of the descending triangle makes lower highs and allows for a descending trend line to be placed. This pattern can also be formed in both bearish and bullish markets. A bullish descending triangle starts with an uptrend followed by the pattern formation. A bearish descending triangle starts with a downtrend followed by the pattern formation. So next, the symmetrical triangle pattern. The top side of the symmetrical triangle makes lower highs, which allows for a descending trend line to be placed. The bottom side of the pattern makes higher lows, which allows for an ascending trend line to be placed below. This pattern also can be formed in both bullish and bearish markets. A bullish symmetrical triangle starts with an uptrend followed by the pattern formation. The bearish symmetrical triangle starts with a downtrend followed by the pattern formation. So we will be showing you how to use this all once we will get to the strategy section. Now, before we continue, this is the most important concept of this entire video. When you are drawing your lines, when identifying patterns, treat them as approximations and as areas. The reason for this is because the market is imperfect and patterns won't always form picture perfect or exactly how you want them to form. If you just wait for picture perfect by the book patterns, you will miss out on 98% of the best trades because, again, the market is imperfect and price movement is imperfect. And to get good at trading, you need to learn how to operate within an imperfect, noisy market. Next pattern, the channel pattern. Now, the channel pattern has three variations. So let's start with the first one, the ascending channel pattern. So the top side of the ascending channel makes higher highs, which allows for an ascending trend line to be placed. The bottom side of the ascending channel makes higher lows, which also allows for an ascending trend line to be placed. The two trend lines are parallel to each other and are both in an upward direction. This pattern can be formed in both bearish and bullish markets. A bullish ascending channel starts with an uptrend followed by the pattern formation. On the other hand, the bearish ascending channel starts with a downtrend followed by the pattern formation. So next, the descending channel pattern. The top side of the descending channel makes lower highs, which allows for a descending trend line to be created. The bottom side of the descending channel makes lower lows, and which also allows for a descending trend line to be placed. The two trend lines are parallel to each other and are both in a downward direction. Also, this pattern can be formed in both a bullish and a bearish market. A bullish descending channel starts with an uptrend followed by the pattern formation. A bearish descending channel starts with a downtrend followed by the pattern formation. So next, the horizontal channel pattern. The top side of the horizontal channel makes same highs, which allows for a horizontal resistance level to be placed. And the bottom side of the pattern makes same lows, which also allows for a horizontal support level to be placed. The two levels are parallel to each other and are both in a horizontal direction. Also, this pattern can be formed in both a bullish and a bearish market. A bullish horizontal channel starts with an uptrend followed by the pattern formation. A bearish horizontal channel starts with a downtrend followed by the pattern formation. Also, right now, if you are enjoying this video, please don't forget to like it and subscribe to the channel. Now, moving on to the next pattern, which is the wedge pattern. So, the wedge pattern has two variations. Let's start with the first, the rising wedge pattern. The top side of the rising wedge makes high highs, which allows for a rising trend line to be placed. The bottom side of the rising wedge makes higher lows, which allows for a rising trend line to be placed. The key here is that the two trend lines are convergent and are both in an upward direction. This pattern can be formed in both a bullish and a bearish market. A bullish rising wedge starts with an uptrend followed by the pattern formation. A bearish rising wedge starts with a downtrend followed by the pattern formation. So next, the falling wedge pattern. The top side of the falling wedge makes lower highs, which allows for a falling trend line to be placed. The bottom side of the falling wedge makes lower lows, which also allows for a falling trend line to be placed. The key here is that the two trend lines are converging and are both in a downward direction. This pattern can also be formed in both bullish and bearish markets. A bullish falling wedge starts with an uptrend followed by the pattern formation. A bearish falling wedge starts with a downtrend followed by the pattern formation. So now, after we covered the three core patterns, let's get into how you actually use the triangles, channels, and wedges as part of our trading strategy. Before we continue right now, go to the comment section and tell us which video topics you want us to cover next. So the foundations of using triangles, wedges, and channels is trading in the direction of where the pattern breaks from. Meaning, this here can be any of the patterns that we showed you previously. So if the pattern breaks above, you should trade in the long direction. And if the pattern breaks below, you should trade in the short direction. So here are all the strategy variations. Let's start with the first. Identifying a trend followed by the pattern formation and then the pattern break in the main trend direction. This is a trend trading strategy. This is the Bitcoin chart on Binance. You have your uptrend before a descending triangle pattern forms. Again, to be clear, this here could have been any of the patterns from this list. But in this case, we have the descending triangle pattern that formed. Now, if price breaks above like this would signal a trend continuation as price broke in the same direction as the larger moving uptrend, as it takes a bullish momentum to break the pattern and makes a higher high. So you would then take long trades through the lower intraday time frame because now the trend continuation is confirmed. Let's show this again. This is Ethereum. You have a moving uptrend before a descending channel pattern is formed. Again, it could have been any pattern from this list that formed, but in this case, we have a descending channel pattern. Now, if price breaks above like this, you would take long trades through the lower intraday time frame. Now, going the other way in a downtrend, this would work the same. You have a moving downtrend before a descending triangle forms. Again, it could have been any pattern from this list that formed, but in this case, we have a descending triangle. Once the pattern breaks below, meaning it breaks in the same direction as the larger moving downtrend, you would take trend continuation trades short. Now, moving on to the next variation. Identifying a trend followed by the pattern formation, but this time the market breaks in the opposite direction of the main trend. By the way, this is a reversal trading strategy. So you first have your uptrend followed by the pattern formation, in this case an ascending triangle. Again, it could have been any pattern from this list, but in this case we have an ascending triangle. Now the pattern breaks below in the opposite direction of the main uptrend, giving a signal of a reversal and a trend change from an uptrend to a downtrend. So in this case, you would take trade entry short after the break below. So going the other way in a downtrend, this would work the same. You have your moving downtrend before the falling wedge pattern formed. Again, this could have been any of the patterns from this list, but in this case we have a falling wedge pattern. So the market breaks the pattern above in the opposite direction of the main downtrend, signaling a reversal and a trend change from a downtrend to an uptrend. You would then take trade entries long through the lower intraday time frame. Now, moving on to the next variation. Identifying a trend followed by the pattern formation, followed by a break in the main trend direction, but instead of taking a breakout entry, this time you will wait for a pullback entry. This is a trend trading strategy and this is the Bitcoin chart. You have your moving uptrend before an ascending triangle pattern formed. Again, it could have been any pattern from this list, but in this case we have an ascending triangle. So, like we previously showed you, once the market broke above, you could have taken a breakout entry long right away, but now more secure traders would wait to see if there is a pullback that occurred, which we have here through the multiple long wick candles reacting to the new support level and the top side of the ascending triangle, and where the moving average also crossed, which create an area of confluence. Then, once you have an intraday trend change, you would take a pullback trade entry long using our trading strategy and tools. Remember, whether you trade the breakout or wait for the pullback, both work fine. It all depends on your style of trading. Now, breakout entries and pullback entries both require you to place a stop loss at different places, which is very, very important to understand, and we will discuss this further later on. Now, moving on to the next variation. Identifying a trend, followed by the pattern formation, followed by the break in the opposite direction, but instead of taking a breakout entry, you would wait for a pullback. This is the reversal strategy, and this is the Solana chart. So, you have a moving uptrend before a descending triangle formed. Again, it could have been any pattern from this list, but in this case, we're having a descending triangle. So, like we previously showed you, once price breaks below, you have a chance to take a breakout entry short, but in this case, for more secure traders, you will not do that and you will wait for a pullback to take your pullback entry, which we have here with the long wick candles forming at this new resistance level and the bottom of the descending triangle. And when the pattern trend line crosses, giving you an area of confluence. And once you have an intraday trend change, you would take a trade entry short using our entry strategy. Now, moving on to the next variation, a pattern forming at a key level. We first identify a key level through this reversal point. Now, as price came back down, we had a descending channel pattern formed right at the key level. Again, it could have been any pattern from this list, but in this case, we had a descending channel pattern. Once price breaks above, the reversal is confirmed and you will take trade entries long. Moving on to the final variation. Identifying a key level, followed by a candlestick formation, and then a pattern inside. Now, before we continue, go to the comment section below and tell us exactly what videos you want us to create next. So, this is the same pattern we discussed previously. We already covered this when you had your pullback entry here, but now there was a second entry using this new variation. So, let's list the pro trades working in your favor. First, you're trading with the moving uptrend. Next, you have the momentum from the pattern break here and the long trade entries that took place here. Then you have your area of confluence here, where the trend line, new support level that recently formed, the moving average, and the fib level all crossed. As price came back down to this level, you have multiple perfect long wick candles reacting to the area of confluence. So after you have the candles reacting to the area of confluence, you need to look inside of the candles and inside of this area to find price actions that signals a trend change from a downtrend to an uptrend. Because even though this is a strong moving uptrend here, this here is a short-term downtrend, meaning price can stall at the area of confluence and then break right through, triggering a larger trend change. Now, a keynote. When you look inside of this area, it doesn't have to be a wedge, a channel, or a triangle. It could be any of the patterns we showed you previously in this video because all the reversal patterns work the same. So let's pull up a daily time frame and let's put it beside this one. The chart on the left is the weekly time frame we just looked at, and on the right is the daily time frame. This key level here is the same key level here. This area of confluence here, where the candlesticks formed, is the same area here. Again, we are looking for any form of price action that signals a reversal from a downtrend to an uptrend. So what we had here is a perfect descending triangle that formed right at the area of confluence from the weekly time frame. Then, when price breaks above and makes a higher high, the trend change is confirmed from a downtrend to an uptrend. Now, here is a very key point. Notice how price didn't go straight up after the break and pulls back slowly before actually taking off upwards. And this is why you need the two most important parts. The first one is to go to the lower intraday time frame to identify an actual entry point with our entry strategy and tool. And second, understanding precision stop loss placement, as there is a very specific place to put your stop loss when you trade in the breakout, but another very specific place to put your stop loss when you trade in the pullbacks. Of course, this one is not the best trading strategy, but it's capable to give you good results and accurate signals. And if you are interested in learning more advanced cryptocurrency trading and technical analysis, I invite you to go to the description below and take our course. Now, I'm giving to you the signals for free. The only way that you can pay me back is by liking the video and subscribing to the channel. And I want you to remember that I'm not a financial advisor in any way. I'm making these videos for entertainment purposes only.